Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger Associates Financial Planning. I'm pleased to have join me today Kyle Ryan, who is also a CFP and one of my leading CFPs on staff. Kyle, thanks for joining me.
Thanks for having me.
So what we're going to do today is another case study. And this is actually a real client, but obviously we changed the names, tweaked a couple things to simplify it. But there are so many different issues that we thought this would be a great opportunity. And once again, the purpose of us doing the case studies is that these may or may not apply to you. Some components of it may apply to you. Some may not. It may apply to somebody you know. The whole idea, again, is to come up with opportunity to be able to provide situations that are real life examples because, hey, at the end of the day, what we're trying to do is provide an educational show and with a little bit of...
What better way to learn than stories?
That is correct. In fact, we've always had people say that people can really embrace it.
Yeah.
When it's something similar.
Yeah, it makes it more relatable.
Yeah, exactly. Relatable is the right word. So this is John and Mary today. All right. Let's try to remember that.
I will do my best. Yep.
You heard the story. I did one with Nick, and he accidentally used the actual client's name a couple times.
That may have slipped through the office.
Yeah, right. Exactly. So at least we have the ability to edit stuff like that out. But anyway, it's all good. So I'm going to lay out some of the base facts. Okay. In short, John and Mary are 62 years old. Okay. Great people. All of our clients are great people. And John's a business owner. Mary works a separate job. I didn't say it right. He's a business owner, owns a business with one partner.
Yep.
Okay. And his partner is a little bit older than him. The two of them have been very close for a lot of years. And the thing about the partner is really he's on his way out.
Yeah, he wants to retire. They've had a good relationship. They've had a good run. He's ready.
Yeah,
Yep.
He's ready. And even you can tell at the work level, and it's not bothering John that much because he knows they're such good friends that, the amount of effort that he puts in on a daily basis is indicative of someone who's on their way out the door. Okay. But be that as it may, and it's recognizable. And, they've had such a good relationship for decades that it's not an issue and he's not upset about it.
And they're open to planning. They very much understand that they're looking out for one another, the business interests, and just the longevity of their financial plan.
Right.
Yep.
So, and this business was originally established by John.
Yep.
Okay. And he brought in his close friend to partner with him for all these years. And so what it is that we looked under the hood a little bit and they're paying each other $200,000 each.
In salary, yeah.
In salary, correct. So they're an escort.
Yep.
Okay. And they have a multitude of employees. I think there's 29 employees.
Roughly, yeah.
It's somewhere around 30 employees, something like that. And their profit is zero, which immediately raised a question that you and I were talking about, and we'll talk more about it.
Yep.
Okay. So the business actually has a checking account with $1.5 million in it.
Yep.
And I remember looking at his bank statement and this is criminal. Okay. A lot of it was in checking, but the balance of it was in their high yield savings.
High yield, you say?
High yield, I say. Exactly. High yield savings. I am not going to name these banks because there's more than one around here that have it, and they're big banks. Their high yield savings was yielding a whopping 0.02%.
Okay. In today's interest rate, where you can get easily 3-4%. Yeah.
Yeah, exactly. It's really 4%, but be that as it may. Yeah. So, that was an eye opener.
Yeah.
And then the business valuation, they really never did much of a business valuation per se, but based on that industry, we're thinking
it's really just about the assets that have the value, the building they own. So it's something in the $500,000 range.
Right.
That we're thinking. Yeah.
Right.
Yep.
Right. Actually, they don't own a building because of the fact that they're really operating on site.
Yep.
So they don't own the property. And in addition to the cash that they have in the business, they're suspecting that the business valuation is about $500,000, plus the cash in the business. If I didn't say it, they have $1.5 million.
It's worthwhile throwing in that John has a son in the business as well. They have 2 children, John and Mary, and one of the children is completely separate of the business, but he does have a son who's in the business.
Correct.
Who is seeking eventual ownership. And that was John's plan all along, that, hey, eventually he'll take over my ownership. And it happens to work out quite well that the partner is planning on retiring, because that could be a shoo-in for him to get some equity there.
Absolutely. Great point. This is all on the business side. They also do not have a retirement plan at the business. No big deal. He's like, well, a lot of the folks probably wouldn't get into it or whatever the case may be. They just don't have a retirement plan.
It's blue-collar work. A lot of them live paycheck to paycheck, so it's not all of them would participate.
Right.
But on the side, as I'm sure you're about to mention, John has a $200,000 IRA, whereas his wife, Mary, through her 401k at work, she's about $800,000 401k.
Right. So they have about $1 million in pre-tax assets. They have about $3 million in regular non-qualified investment accounts.
Yep.
And they have,
last but not least.
Well, actually, last but not least, but we're certainly going to save that for last, is they have 0 Roth IRA.
Correct.
Okay.
Yeah.
But last and certainly not least, about $20 million in rental properties.
Yep.
Okay. Which,
is a good problem to have, but does present its own tax and estate planning issues.
That is absolutely correct. And so this is going to be a complex estate planning case.
Yes.
Because as it pertains to all these rental properties, you don't want to gift them, because then you lose the step up in basis.
Correct.
And so that's going to be tricky.
Yep.
So,
and if you hold on to them, they keep increasing in value, and all of a sudden you're
right. So we're really, there's a lot of moving parts here. If there's one thing that jumps out is, while it's not an estate planning case today, it probably will be. Okay. Wait, let me rephrase. It's not an estate exemption issue today.
Yes.
But it probably will be.
Without proper planning, yes.
Right. Okay. So these are the base facts. What we like to do is kind of jump into it. And really what it came down to is they really fit the bill of every single area of financial planning. And we always reference the 6 areas of financial planning: cash management, tax planning, risk management, which is insurance planning, investment planning, retirement planning, and estate planning. And boy, do they check every single one of those boxes. Okay. So anyway, I guess let's talk about cash management.
Yep.
Okay. Well, the obvious thing that jumps out, and by the way, it didn't reference, they also have another $1 million, in a checking account. Same concept as the business,
yeah.
But for the rental properties. And they need it because, you got money coming in, coming out.
Yep.
They've done 1031 exchanges. They're buying properties, they're selling properties, they're flipping properties.
Like the other week.
Right, I know, exactly. Oh, they haven't done any this year.
Yeah.
But, the fact of the matter is they have $1 million sitting in that bank account, earning in their high yield savings
0.02.
All 0.02, not 1. That's double 0.01.
0.02.
I know. Holy smokes. So anyway, this really lent itself to the obvious, let's do something better with your cash.
Yeah, the opportunity cost of something like $2.5 million alone. If you're earning 4%, you just got yourself $100,000 of interest without taking any additional risk.
That's correct. And so, one of the things that we'll do is we'll look for opportunities, doesn't want to sever the relationship with the bank that they've had for a long time.
Of course not.
And so what we're talking about doing is moving all that he feels comfortable with out to either another bank or another financial institution, is a better way of putting it, and moving the money in to another financial institution, which then raised, I'm going to sort of teeter between cash management and tax planning.
Yep.
Right now, they are in the 24% tax bracket. Okay. If he could earn 4% in a money market, it's the equivalent, which is taxable. It's the equivalent effectively as 3% in a municipal. So what we're looking at is hey, do we go after the money market where we can get 4%, or do we go after an extremely low risk, tax-free municipal bond portfolio that provides 3%? And we kind of decided that that was the route that made sense for him to go. But what's important to understand is anytime that you're doing cash management, because it truly is cash management, it needs to be virtually zero risk.
Yes. Yes. If you need that money in 1 to 2 years, anything like that, no, there's absolutely no reason to take risk with that.
Right. And it's not even 1 to 2 years in this particular case.
Yeah, it's sooner than that.
Right. And at the end of the day as well, he needs to be able to have instantaneous liquidity.
Yes.
So we have the ability to help him set up the money in a different financial institution. We're not buying CDs. Yeah, you might be able to make an extra 0.1 or 0.2%, but you lose your liquidity.
Yes.
Okay. And we may do that with some if we don't need some of the money for a few months out. And we're going to lay that out because this is still preliminary because we only met these folks last month.
Exactly. And if we're even thinking about CDs, we'd consider treasuries at the same rate. So then you don't pay your state tax on it. But those are things that, we go through.
Right. But we're in Pennsylvania and the state tax isn't that high. But hey, every little bit counts.
3%, right?
No. It's true. I'm not belittling what you're saying. But every little bit counts and we take that into consideration. So, the other thing that we need to make sure is when we say liquidity comes in a lot of different flavors. You want to be able to sell it without having to worry about taking a loss.
Yes.
And you want to be able to know that you can access it quickly.
Yep.
And if you do that, whether it be money market or some type of ultra short municipal bond investment, and there are plenty of them out there. Rule of thumb, money markets, and I know you can do 4.1 or 4.2, 3.9. For the sake of argument, we're calling it 4. An ultra safe short bond, muni bond 3, basically means they're effectively equivalent.
At his tax rate,
At his tax rate, correct. So you want to make sure there's no risk, and you want to make sure that they can get it quickly.
2 to 3 business days. It's not something that you want to have to wait a month because you never know. Crisis can arise, opportunity can arise where you need access to your cash.
Correct. And so what you'll find is most investment organizations, whether it's a brokerage account, a financial institution like Fidelity or Schwab or Vanguard, and I'm not here to talk about other financial institutions other than just using them as an example. Okay, you can get these investments and just know that it's an investment, unlike a bank account, where literally if you have a bank account and I wanted to move it from my high yield savings to my checking account, it's instantaneous.
Yes.
Online, if it's the same bank. Here, it's 2 to 3 business days. Because what happens is that if you were to call us, and let's just hypothetically say us or whomever the financial institution is, you call them and you say, hey, I want $100,000. They have to sell the investment. Well, the investment is available in cash the next day.
Yes.
And as long as it's a one-day sweep, then it's in your checking account in 2 days from the time that you make the call.
Yep.
Now, 3 business days if you call after 4 o'clock because the markets are closed.
Exactly. Yep.
All right. And always be cautious because we've run into this before a few times, is sometimes you have those weird holidays that land in the middle of the week. Okay. When I say weird holidays, not your, Christmas
or something, New Year's.
Right. Easter is always on a Sunday. But you've got Labor Day and Memorial Day are always on Monday. Yep. You have ancillary holidays that sometimes land in the middle of the week. So just always plan for that.
Yeah.
But generally speaking, most business owners and most people, unless they're dealing with Mario and Luigi, you're going to show up with baseball bats at their door.
You don't need your money.
Right.
You have
usually
a little wiggle room.
You could plan it a couple days.
Yes.
All right. So that's what we're doing. We beat that horse to death. So that's what we're talking about doing there. Tax planning takes on a life of its own.
Yeah.
So what I'd like to do is talk, because it's a very brief thing, about insurance planning. So, insurance can cover a whole litany of different things: medical insurance, automobile insurance, homeowners insurance, life insurance, disability insurance, et cetera, et cetera.
Yep.
Yeah, we looked at him from a disability insurance perspective. The reality of the situation is
62 years old. How many years of coverage can you really get at that point?
exactly
Right.
Okay. Life insurance is designed to provide an alternative to replace your pay.
Yep. The only consideration, the true consideration for life insurance in this example would correlate to the estate planning.
Yes.
If we did see that there was a serious risk of them exceeding the federal exemption limit, which is $15 million a person, you exceed that, you can pay taxes as high as 40% of your estate. If there was the risk of, hey, if you passed away today and you were well above that, your children have to pay X amount of millions of dollars, it could force a fire sale, per se, of the assets that, like their properties that they might otherwise not want to sell.
And we're going to talk more about that later because that is a big issue.
Yes.
They have medical insurance to work.
Yep.
They don't need disability insurance. They don't need life insurance for the sake of protecting his pay.
They're going to throw in long-term care insurance, which arguably they have enough assets, liquid assets, that you'd say that you don't have to.
They can self-insure. They could self-insure. Yeah. So where it came down to is property and casualty insurance.
Yeah.
So I don't even remember how many properties, 70 properties or something like that.
It's a lot.
Yeah. Okay. So the question becomes twofold in that arena. One of the problems is that if you insured a particular property 10, 15, 20 years ago, the property may have been $300,000 at that time.
Yeah.
If you're not consistently reviewing the property coverage, that property may still be covered at 300, but it's now worth $500,000 or $600,000. So if you have a fire or whatever the case may be, suddenly you're underinsured.
Yeah. Look at the real estate market in the last 5 years. If you haven't reviewed your coverage in the last 5 years, I mean, if you own a home, you know how much it's increased in value. It's probably a worthwhile consideration, especially if you're managing as many rental properties as he has. That's a consistent effort he has to go through.
Right. Yeah. And then the second thing that we asked him about is, when's the last time you looked at umbrella liability insurance? And so, I wouldn't characterize ourselves. In fact, I would characterize ourselves as not being experts in property and casualty. No. But, as CFPs, we need to understand and know all the different things. And that was one of the things that we said to him, is that you need to march down and have a very, very long and detailed discussion with your property, with your property insurance.
Exactly. Yeah. The last thing you need is to have some sort of lawsuit unexpectedly arrive at your door. Someone trips on a curb outside one of your many properties, and all of a sudden you're forced to once again do a fire sale because you're covering a lawsuit. So these are things that umbrella insurance, homeowners coverage, separately address some of these risks.
Right. Yeah. So what we'll do, taking a short break right now, what we'll do is we'll talk about some of the other planning situations that we have. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained, as we're picking up the case study with John and Mary. The other topic that was outside of the 6 areas of financial planning that is directly applicable in this particular case is business succession planning.
Yes.
And in this particular case, albeit the value of the business is not that huge, the whole idea of changing from one owner to himself and then potentially passing it on to his son takes on a little bit of life of its own.
Yes.
Okay. So one of the things that's going to have to happen is he's going to need to buy out his partner. And if they value the business at 250,000, I'm sorry, 500,000, he would need to give his partner 250 grand.
Yep.
However, the irony of it is that he had a soft-spoken agreement with his partners. Go ahead and retire. And what I'll do is I'll just pay you a year's worth of salary and fine. And he takes off.
Yep. Cover your health insurance.
Right, exactly. And, that was around, about the equivalent of half of the business.
Yep.
Well, I said, John, here's the problem. If you do that, he's still a 50% owner of the business, which means that the business next year, if you remove his $200,000 salary, instead of having a $0 profit, it's a $200,000 profit. He's a 50% owner. He's getting $100,000
legally. Yes.
Right.
Yep.
So, and he goes, oh, so he's like, we need to talk about this.
Yes.
Okay. Which then led to the next of how do we pass the business on to his son, which in its own right was a pretty cool idea.
Yeah.
Because what we're talking, we haven't done it yet because it's just so preliminary. And by the way, I'll have you know, before we get into that, what we did is when we met with him the first time, we talked about all these ideas and we talked to him several times. We said, you know what? This is the exact reason why we need to be in the room with your CPA.
Yes.
Okay. Because there were so many issues that we were bringing up. And by the way, here's the irony of it. I've never had a financial advisor in my life.
Yep.
I never saw the need, never saw the value that one could possibly bring. And now he's so happy that he is seeing a financial advisor and is even happier yet that we suggested to him
to meet with the accountant.
Right. And the irony of it is when he told the accountant said, you'd be surprised how many people I know or how many advisors I know don't want to talk to the accountant. And those are the people that you should be concerned with.
Exactly. Yep.
Okay. And the irony of it,
planning attorneys. Yep. It's
the irony of it is that we know a lot about taxes and tax planning. And because of it, we're the ones who are saying we need to have the accountant. And those advisors that don't know enough about it
just go ask your accountant.
or they want to exclude the accountant.
Oh, yeah. Yeah.
It's like, that makes no sense to me.
Yep.
Okay. Because one of the things that I always believed in, still do, is that I wholeheartedly believe that two heads are better than one. Okay. Because inevitably, I may not see something that somebody else will see. They bring it up and then we'll have an argument, if that's the right word, discussion. Yeah, no, just, it's not even an argument. We're arguing a point.
Yeah, you're looking at the same set of data from two different lenses.
And that's what's beautiful about having a good CFP with a good CPA. And the joke I always say is that, if the client introduces us, puts us in the room, then walks out of the room and shuts the door behind him, and then we go fisticuffs with the CPA, and then the client comes back in about 15 minutes, you know who wins? The client.
Yeah.
The client wins because, to your point, the CFPs are looking way ahead. We understand the taxes, but we have sort of a different viewpoint.
Yeah. And they're looking more so this year, last year, how can we maximize tax efficiency for this period of time?
Right. And not to mention, though, in favor of the accountants, they know way more about taxes than we'll ever know.
Absolutely. We know a good sliver of the wedge of taxes as it relates to personal finance.
That's correct. But in this particular instance, it became even more prudent because of the fact that in order for us to accurately do any type of financial planning and tax planning, holy cow, he's got some moving parts here. All right. I say he, but they.
Yeah, especially if, you make recommendations of changing tax planning within the business, who the accountant's running all the QuickBooks and their bookkeeping and everything. You want to make sure that the accountant and us and obviously the client are all on the same page with our recommendations.
Exactly. And then the other part too is that if we're doing tax planning by trying to bring their income up to or down to a certain level, we're missing one major piece. And that's the management of those 70 properties.
Yes.
Okay. Are they coming in at a gain? Are they coming in at a loss? How much? If it's at a loss, it's no big deal. You can't write off the loss. But if it's a gain, that throws things off.
Yeah.
Okay. So we actually did have the opportunity to meet with the accountant. Yeah. Great Zoom call. and talked for about an hour, presented all of the issues, and the accountant loved it. And what we agreed upon is to meet around December 1st.
Yes.
Okay. Because what we're going to do is we talked about the issues. We're already addressing some of the issues now because of the fact that they're time sensitive. And then we're going to be sharpening our pencil roughly December 1st to get a sense of what is the actual income looking like, because some financial planning or some tax planning can be done after December 31st, but some has to be done during the calendar year.
Yes. So while we're strategizing now, it would be inappropriate for some of our tax recommendations to implement them without really, like you mentioned, sharpening the pencil on what does that rental income look like? What will that non-qualified investment income produce from a taxation perspective? So all these different things, we have a much better way of predicting that once we are toward the end of the year as opposed to sooner in the year.
Right. And so the other thing that happens, call it investment planning, call it tax planning, whatever the case may be. We did transfer all of his accounts over. And so what happens this year is that the clients are going to be getting 2 sets of 1099s from their investment accounts. They're going to be getting 1099s from the prior financial institution, and they're going to be getting 1099s from us.
Yep.
So what we have to do in circumstances like that is, again, we have to work very closely with the client so that after the move is completed, which it is, is we need to be able to go back to all of their, we know they're going to get a 1099 from the other firm, from the other financial institutions. What we need to do is know in advance, because they're not getting those 1099s until like mid to late February of next year, at which point, too late.
We need to know what was on them. Or we need to know what the taxable income from those accounts were before we got them.
Correct. So what that does is that gives us the ability to be able to go in, and in some cases, we'll be able to get statements. Other cases, we may end up having to sit with the client as the client goes into his online accounts so that we can explore through there to find out year-to-date ordinary dividends, qualified dividends, short-term capital gains, short losses, all of the stuff that from this point, starting next year, moving forward, that's what's nice about having it under our own roof, is because we can actually better serve the client. Because we can see what's going on.
Extend it further. We were mentioning the accountant before. We send those right to the accountant.
That's correct.
I know we coordinate with the client, say, hey, is it okay if we're coordinating with your accountant on your behalf? Can we send them tax documents, get the proper form signed, you name it? But makes everyone's life easy. Cut out the middleman.
Absolutely. And so
Accountants love it.
The accountants absolutely love it. And so that's the other thing too that happens. It's a formality, but it's CYA type of thing, is that there needs to be an agreement from the client to allow for the accountant or any of their business professionals, but there has to be an agreement that the accountant and us can talk to each other about the client's stuff. Boy, he's tickled pink, to be able to do something like that. So one of the other things that we do routinely with all of our accounting relationships, not all, but a lot of our accountant relationships, is we actually have these agreements in place. And then come February, what we do is we create files.
Secure shared folders.
Secured shared folders where we upload all the 1099s. Okay, whether it's a 1099-R, a 1099-INT, 1099-B, 1099-DIV, all that stuff, because it's remarkable how it saves everybody time.
And even better, once April rolls around or whenever they get their tax return filed, they upload, the accountant will upload the tax return to us, because we use that. We need that for proper planning and making sure that everything we were planning to be listed on that tax return is listed as we had intended. No surprises.
Exactly. And then going back to us uploading, the reason why it saves everybody time, because inevitably we always get the calls around mid to late March, early April. Can you help me find this 1099, or can you help me find this? And did you give me this? Or we get the calls from accountants, which what we always do is we ask our clients to tell us when you're meeting with your accountant, because I put that on my calendar and I tell them that if during your meeting you have an issue, you and or the accountant should call we make a point of being able to answer that call immediately.
Yes.
Because the accountant wants to be able to answer that question immediately so they can forge ahead and proceed with the preparation of the taxes as opposed to coming back.
Yep.
It saves that. It saves having to file amended tax returns because they were missing 1099.
No one's happy.
Happens all the time. I mean, all the time, but it happens enough.
Often, yeah.
Enough. So what it does is it saves everybody time. Saves us the time of receiving those phone calls.
Yep.
It saves the client the time and the aggravation.
Love
saves the accountant.
Yep. And it's like when you're working on something, you get a roadblock and all of a sudden your motivation's shot because you just can't get what you need to do and you have to pick it up later. So it's just easier just to get it done right away.
Well, aside from the motivation, you're into it and you know it.
Yeah.
And next thing you know, you got to relearn it.
Yep.
So I think what we're going to do is we're at a good breaking point that we're going to end this particular episode. And what we'll do is we'll come back and pick up in a second episode a lot of the true planning things that we encountered, because these are really, really cool things. So thank you for joining us for the first of two-part episode on a case study with John and Mary. Thank you for, I hope you learned something. We didn't really talk about a lot today, but I hope you learned something. And we'll see you. Thank you for joining us. We'll see you in the next episode of Financial Planning Explained. You have an absolutely wonderful day. Thank you. Thank you for watching this episode of Financial Planning Explained. We strive to provide an educational experience for all of our viewers, and what we struggle with at times is topics. So if there is an idea or a topic that you would like for us to discuss on a future episode, please email us at admin@maaplanning.com, or you may enter it on the Contact Us page on our website at www.maaplanning.com. Thank you in advance for participating and helping make our show successful.